All right, welcome back, traders. John Caruso coming to you here. Another edition of Futures Forecast. It is Monday evening, February 20th. We're recording for Tuesday, February 21st. Of course, today was President's Day. It was a holiday. Markets were closed. So we're coming to you here on Monday evening. So we're going to recap last week, hopefully get you guys off to a good start for this week. So last week, the S&P 500 did finish down 0.40%. We still have the S&P 500 trading up 6.1% year to date. The NASDAQ was actually up 0.20% week over week, but that did finish well off of its weekly highs. 10-year yields up 8 basis points on the week to 382. And crude oil was down 4.2%. That remains bearish trend with neutral momentum. And crude oil just largely is living inside of about a $10 to $11 trading range. Gold price is down 1.3%. We actually did see gold fall back to the opening prices year to date. So that was very interesting. We did see a very strong rejection, perhaps a strong low like we've been looking for here on the charts that could potentially take gold prices back to the upside over the very near term. We're going to take a closer look at that. CPI last week came in sticky high. We did see PPI sticky high as well. Retail sales was a blowout number, up 3.0% month over month. We did see consumer credit card debt levels explode to multi-decade highs. So that's very interesting. You got to be asking yourself at this point, how much longer can the consumer really hang in there? They are certainly hanging in there based on the latest retail sales number. But with credit card debt levels exploding to multi-decade highs, you really got to be asking yourself, or you got to be telling yourself that the U.S. consumer is certainly on borrowed time right now. Industrial production 0.0 mark was looking for up 0.5%. The Philly Fed Index, big time surprise on the downside at minus 24. So we are starting to see some of the growth data really start to turn over. Clearly, we've seen that in the manufacturing sector. We've seen that for the past couple of months now. But however, with those retail sales numbers coming out very strong, of course, the consumer is 70% of the economy. They remain robust at the moment, but certainly some signs that that things are beginning to capitulate in terms of those credit card debt numbers. Money supply as well. M2 money supply. For the first time recently has gone negative. For the first time, we've got charts all the way back to 1960 that show steady M2 growth in the money supply. And for the first time over the last 30 days, we actually have seen the money supply actually go negative for the first time since 1960. So we're talking, 63 years roughly. So very interesting from that regards. Taking a look at the charts, let's get into it right now. We've got the March S&P 500 up in here. Clearly, something is changing over in here, but we're going to kind of go back year to date and review all of this upside action, very strong action. We did see a little bit of a mini breakdown here in our last analysis of the March S&P 500. This breakdown in here, we were actually expecting it to hold the center line of the Bollinger Band. That breakdown came off of following David Rubenstein and Jay Powell's little one-on-one conversation. Did see that mini breakdown right there. However, we did expect this market to once again rescue itself, try to reattack these old highs, potentially push beyond to 42.20 to 42.30. We did not quite get that high. We only got as high as 41.86. And now we're starting to see some more pull down in this market. As you can see, going back to Thursday gave you a pretty good warning sign here where we saw that breakdown following PPI and some hawkish Fed speak. We did break through that bottom part of that channel and we closed below it. We actually closed on Thursday at 40.95. That was a warning sign that the next logical place this chart was going to try to test was going to be this swing low back here from February 10th down at 40.60. And precisely that's what happened. We got down there, broke through it, which is now telling me that something's changing and that you really should be looking. This chart now looks like any upside rallies into here are going to be selling opportunities in this market. So we did break through that, rescued itself a little bit. And now, of course, on Monday evening, we are starting to see a little more follow through on the downside. We're down 16 points at 40.71 in the S&P 500. So I still believe that if we do get another wiggle up in here, maybe 41.30 to 41.40, that is a selling opportunity in this market. That's an opportunity to get bearish if you're not already there. For another breakdown, we did mention in our last several futures forecast analysis that a period of risk was coming. February, March to April was the period, that 90-day period we did have mapped out. For a period, we were going to start to begin to see some risk off in the market. Now, the deepest we have it drawn in here is back to the year-to-date opening prices, which come in down around 38.25. That would wipe out the 6.1% year-to-date gains. I do think that is probable, that that's going to happen. But I don't have it projected to really break down past this consolidation area or the year-to-date opening prices. If we were to take out this swing low down here at 37.88, then that's going to be a warning sign that we're going to play for last year's, the 2022 lows again, down along 3,500. But that is not my base case at the moment. My base case right now is that we reattack the year-to-date opening prices down in the low 3,800s before we start to see the market begin to rescue itself. And perhaps we're just in we're going to carve out a large trading range here between 4,200 on the upside and 3,800 on the downside for the foreseeable future. But nevertheless, over the very near term, over the next 30 to 60 days, we do think a much larger breakdown in this market is likely coming. So be on guard for that. We're going to jump over to the 10-year yields here, show you what we see there. 10-year yields had a very strong week last week, up 8 basis points. Actually got as high as about 390, 388, 389. Played for this swing high up here. As you can see, our past analysis in here has been pretty accurate, where we had that downside, not breakdown, but we had a little pull down in here. We thought it would rescue itself. It did. And then we actually thought we were going to see a bigger breakdown in yields. That's not what happened. We did actually pull down once again to this trend line, this longer term trend line, and it rescued itself off of that level. And now we're pushing back to the upside, attacking this swing high over here. Any downside in here, I can't really get you too far on the downside before this thing likely makes another run, potentially back towards those 2022 highs up around 430, maybe. I'm not sure. I do believe that if we were to see 10-year yields back above 4%, that the stock market is going to have a real problem with 10-year yields back above 4%. So you got to remember that we do monitor the 3-month Treasury bill rate as well as the 10-year notes. And typically what happens when those two spreads invert, where you start to see the 3-month over the 10-year, typically what happens is 10 to 18 months following inversion, we do experience a recession in the economy. Now, we did see that spread invert about 30 to 45 days ago. I believe it actually is a little bit longer than that. I believe it happened towards the end of November, early December. You're going to have to fact check me on that. But right around that time, we did see those two interest rates invert. And typically what happens after that 10 to 18 months following that, we do get the Bureau of Labor Statistics calling a recession for the U.S. economy. So that puts us towards the end of this year. We actually have it forecasted right now that we're gonna see a recession called in Q3, just because our Q1 GDP tracker and Q2 GDP tracker are negative right now. So we're going to see how that plays out. Nothing's written in stone, of course, but sometime in the back half of this year, we actually do believe that a recession will be called by the BLS. So that is a look at the 10-year Treasury yield. We're going to step over to the gold market here. And I reviewed this on Friday in a quick hitter. So we'll review it again here for you guys. Clearly, we had the strong melt up in the back half of last year, beginning part of this year. Then we saw that big breakdown on the charts. Market was down over $100 inside of 2 days. We did actually think we were going to get up here, testing that 78.6 before we started to see some pull down. Now, I was surprised by how strong this pull down came, this massive rejection. And then, of course, we saw the bear flag begin to develop in the gold market, and then we saw the breakdown again. We did break down on Friday to the year-to-date opening prices down at 1828, And we did see a hard rejection off of those lows. So perhaps this is the hard bottom that we've been looking for in the gold market that perhaps tries to chop its way back into potentially 1880, potentially as high as 1900 before, as you can see, we have it drawn in that we're going to see another period of risk that happens out into March, potentially into April as well. Now, why do we think if we retest up in here that we're going to get a rejection? Because this rejection right here, these near-term bearish forces are still very much in play on this chart. So any upside we see in here is likely going to be stemmed. And we're going to see this reject one more time, potentially double bottom at 1827, but we think it could get as deep as 1800 to maybe the 200-day moving average around 1785 before the market tries to reattack higher. And ultimately, we do think that gold prices are going to experience all-time highs, if not into the end of this year, out into 2024. So keep that in mind when you're trading gold. So that's a look at gold. Let's jump over to the crude oil market quickly, and then we're going to wrap it up here. This is a look at crude oil on the weekly. Let's go to the daily here. Clearly, what we're staring at is a very mature downtrend. Obviously, this market has carved out 83 on the upside and about 70 on the downside is that trading range. Any break. Now let's take a look at this here. We do have neutral momentum. Let's say I've got the low end of my range right now at about 74.15. This is tough to give analysis on because it's just wildly sideways. If we were to attack back into the low 80s again, I would expect another rejection back towards the low 70s. This level right here, 72 and a quarter, has to hold. If 72 quarter blows out, then I think we're going to see 66, maybe 65 on the downside. But if we are able to hold down here, if it retests down in that level, I don't have an oversold signal just yet. So maybe we get to the low end of the range, 74. If we can get back into the low 80s, potentially over 83.50 to 83.90, then I think something bigger is going to develop on the upside. And I do think that we are now out of this trading range and potentially going to at some point reattack that 90 to 92 area, which would be the next major hurdle for crude oil prices. But until we break out of this sideways trend, the analysis in here, it's very confusing. 72 and a quarter on the downside has to hold. Otherwise, we're going to see another breakdown into the 60s. And if we can get above 83.50 on the high side, then I think we're probably going to reattack that $90 area at some point. So I'm going to leave it at that on crude oil. Very, just a sideways choppy trend in crude. So that's all I have for you this evening. I'm John Caruso. If you have any questions, feel free to reach out to me anytime at jcaruso@rgofutures.com. If you want to jump on our morning market insight letter, feel free to drop me an email, and I'd be more than happy to add you to that letter as well. And best of luck to everybody out there. If you have any questions, once again, reach out. Good luck. Catch you back here next time.